We now move to the second participant in this morning's program, Senator Chuck Schumer. Senator Schumer represents the great state of New York, and I say great with feeling because I was born and grew up in New York State. I left too many years ago to have been a constituent of the senators, but I follow events there much more closely, I'm confident, than the average Marylander. And as an economist and a former New Yorker, I've been very pleased to see New York represented by someone who takes so seriously the opportunity and the responsibility of the U.S. Senate in guiding American economic policy. Senator Schumer is a member of the Senate Finance Committee and the Senate Committee on Banking, Housing, and Urban Affairs. He is also currently the chairman of the Joint Economic Committee. Under his leadership, the JEC has produced a number of very insightful reports on a wide range of topics, including the subprime mortgage meltdown. And the senator has been one of the most active voices in recent months in exploring and advocating policies to address our current economic problems and to help American households. Please help me in welcoming Senator Chuck Schumer.
I always ask when you're from New York, where you went to high school. That's some parts of New York, it's what parish are you from, and in every part of New York, it's what high school you went to. And Mr. Elmendorf went up in Poughkeepsie to a very fine high school. I went to Madison High School. I was a basketball player there. Our team's motto was, "We may be small, but we're slow." But Madison has great distinction because we are probably the only high school to have 3 senators in the United States Senate, and probably the only ever to have 1 a Democrat, me, 1 a Republican, Norm Coleman, and 1 an independent, Bernie Sanders. So I doubt any other high school has that. But anyway, it's good to be introduced by a New Yorker. I'm honored to be here with my friend Larry Summers. He's done an amazing job on issue after issue. When I have a problem or need some explanation, I call Larry, and his explanations are practical, incisive, deep. I mean, he's just great on issue over and over again, and not always conventional either. So I very much appreciate his staying active in the policy area, even though he's no longer Treasury Secretary. I also want to thank Brookings just for being the great institution that it is, and want to thank Doug and so many of the scholars and residents at the Institute. Now, Larry has done a great job laying out some of the serious problems facing our economy and steps we need to take to stave off the dreaded R word, recession. I want to talk a little more in depth about the subprime mortgage crisis, which I believe is at the center of all of our problems. It's not the only cause or maybe even the largest cause, but it's there. The subprime crisis has become a symbol of the Bush administration's serious mishandling of so many economic and domestic policy priorities. Just as Katrina sort of became the metaphor for the administration's inability to manage government with the ham-handed efforts of FEMA, the housing mess, which has hit homeowners and neighborhoods with too many foreclosures, credit markets with mountains of debt, and the economy with weak job and economic growth, is further evidence that this administration all too often is ideologically handcuffed and cannot step up to the plate to solve major problems. As our country teeters on the edge of recession for the first time since 1990, the administration is almost powerless to really roll up its sleeves and involve itself in the problem. And you ask yourself the question, why? There are very talented people there. Secretary Paulson, Deputy Secretary Steele. And it's my belief that, as I said, they've had ideological handcuffs imposed on them. Keep the government out of any solution. Do whatever you can, but keep the government out of any solution. And the administration ends up tying itself in a pretzel to come up with solutions that are not direct, that don't really hit the bullseye in terms of solving the problem, and make the crisis worse. And they're always a step behind for the same reason. Now, the administration seems to be unable to get the government moving quickly, decisively, and competently to address the most serious economic crisis we've had in the last decade. It is this irresponsible inaction, attributable in my judgment to their ideological opposition to government action, that has exacerbated the housing and economic woes we are facing. And our housing problems have rippled through the economy. The fact is that economic contagions are difficult to contain. It's not like a bottle of water. It's much more like a pond where the ripples move outward, but in this case sometimes get larger. The initial ripple is the foreclosure problem, the very serious problem of foreclosures. But it doesn't stop at foreclosure. The statistics show that every time there's a foreclosure in a community, housing prices decline. And so you've had a decline in housing prices, not all of which is caused by the subprime foreclosure crisis, but certainly been exacerbated by it and probably is a leading, if not the leading cause. The ripple goes outward further. Housing prices decline and the consumer buys less. And here we are, and we're getting reports that this Christmas season isn't a very good one. And again, there are other reasons as well. There are high fuel prices, for instance. But one of the main things that the studies show is when housing prices go down, the consumer feels less flush and spends less. And then finally, there's probably the most outward ripple, which could have the greatest effect, which is the credit crunch. If people aren't lending, if lenders aren't lending to businesses and to individuals, the economy really has a crimp put in it. And so the crisis, the problem, call it what you will, just moves outward and gets larger and larger, and the administration seems unable to aim at the bullseye, to aim at the problem and help ameliorate it, help mitigate it, and thereby lessen the severity of the ripples that move outward. Now, I believe that we could have avoided a lot of this. There's no doubt that an economic slowdown would have occurred, but the administration's inaction could well spell the difference between an economic slowdown and recession. Now, first I want to focus on 4 myths surrounding the subprime crisis and particularly the administration's limited response. And then I want to take time talking about 7 steps we need to take to handle this crisis and leave the rest of the time for your questions. The first myth is, all this new subprime lending created a huge number of new homeowners, homeowners that could never get homes before, now do it through subprime. Not so. There are some. But guess what percentage of subprime loans went to first-time home buyers? 11. 1 out of 10. Okay? Guess where most of it went? Guess where the plurality went? Not to new homes at all, to refinancings. 47% of the people who borrowed did not buy a new home, whether it's their first home or second, were not even speculators who were buying homes and not living in them. 47% were just getting cash, sort of like a home equity loan. They needed it for one reason or another. 9% went to investors and speculators, and the remainder went to people who bought and lived in homes, but it wasn't their first home. They were buying up. That's the first myth. The second myth, the unqualified borrower. The second myth is, this is all the free market dogma. I believe in the free market, believe me, but it isn't perfect. And a clinging to the belief that it's perfect and that's all you should rely upon helped create the crisis and helps prevent us from getting out of the crisis. So the second one is, none of these people could have gotten loans if there weren't a subprime market because they couldn't get prime loans. Wrong. 55%. I was by the way, and this is frustrating to me. I've been involved in talking about this crisis. I wasn't as early as Mr. Gramlich or someone like that, but I've been talking about it for about a year. And starting in the spring, I mentioned this, that 55% of subprime borrowers would qualify for prime loans. They had both the credit scores and the income to do it. 55%, more than half. No one paid attention, finally. I don't know if anyone's here from the Wall Street Journal, but God bless you. They wrote a story on the front page about 2 weeks ago, 3 weeks ago, and now people are talking about it. 55% in the Journal's analysis. This confirms what Martin Eakes and others at the Center for Responsible Lending have been saying for a long time, so have I, had credit scores worthy of prime conventional mortgage in 2005, and by last year it was 61%. So this idea that, well, the subprime market, it's gotten all these people who never could have gotten money. It did get some, no question about it, but not most. Third, the myth is that there's perfect knowledge. This is always where the free market falls down, the analysis. If you don't take into account lack of perfect knowledge and externalities, you run into trouble. And yet our doctrinaire people, too many of whom are governing the administration, that's what they do. So, perfect knowledge, that's the problem here. Everyone assumes, well, all these borrowers knew exactly what they were getting into. This is part of the dogma. They knew exactly what they were getting into, and they made a mistake and they should pay the price. But they didn't. It's been about 20 years after Adam Smith came out that people realized that there was not going to be perfect knowledge, and we had to compensate for that. And yet we still have that myth going on now. How many of you read your entire mortgage document? How many of you? I didn't. I'm a Harvard lawyer. Now, probably many of you in this audience hired a lawyer to do it. Do most homeowners hire a lawyer before they buy a home? They can't afford it. Of course not. And so people don't have knowledge of what they were getting into. They're responsible. They signed the statement of the 35-page document, but to assume they knew it and now they should pay the price, that's ideology straight out of the 1890s. It reminds me of the people who, I get people who tell me this all the time. At Christmas party Saturday night, 2 people came over to me and said, look, they got into their trouble. They should pay for it. I said, well, do you believe that we should not regulate medicine? You should take a quack medicine and die, and everyone else will learn from your experiences. That's how the perfect free market would work. But we don't do that anymore. We haven't done that since the 1890s. But somehow that kind of thinking, that kind of myth has gotten us into this. And the fourth one is the most important and relevant one of all, that the free market alone will solve these problems. The administration is wedded to the philosophy government should take a hands-off approach to governing and dealing with these crises. And that myth, left to its own devices, the myth that left to their own devices, free market forces will correct these disruptions caused by the subprime crisis, has caused us perhaps the most economic pain, because it's allowed the subprime crisis to grow and grow and wreak havoc in the other areas of the economy. It is true. Left to its own devices, the free market will solve the problem negatively, will maximize the number of foreclosures, and the economy will eventually dig out of a hole. But the bottom line is there are externalities. So that, for instance, I have paid my mortgage completely, but the homeowner next to me hasn't and is allowed to go into foreclosure, my home values go down. The studies show it. But the cost of my home going down isn't calculated by whether he should foreclose or not. It's an external cost. Our economy, being complicated, is loaded with external costs. And yet these ideologues don't do it. And so in other words, the cost of foreclosure in the costs and the outer ripples is not captured. So the declining housing prices is not captured, and the freeze in the credit market is not captured, and the overall downturn of the economy is not captured. And so the free market alone can't fix this, and that's what we've seen in terms of the rippling out. And you can see this by the administration and what they've done. They just are a step behind all the time because they keep thinking the free market is going to solve this. And the reason they think that is because they don't take externality. It's a very simple, easy theory. But the world is complicated. Okay? And I'm not going to get into all of those details. But summing this up, I want to give you one little example of somebody who was a victim of this crisis. I've met lots of these folks. That's how I knew about this before a lot of other people did. But Frank Ruggiero, he passed away a month ago, but his death isn't relevant to the story. Frank is your typical subprime borrower. Frank is was a subway motorman, retired, who lived in Ozone Park, Queens, in Nativity Parish. I don't know what high school he went to. And he had a good pension of about $28,000 a year, and his Social Security was $11,000. So there was Frank with $40,000 a year, and he had a home that had a 30-year mortgage that had decent value, and he had paid 16 years on the mortgage. And Frank was a prime borrower. His FICO score was above 700. He always paid his bills. Okay? But Frank got diabetes. And somehow his health care plan didn't pay for the treatment that he thought was the right treatment. And so he read in the newspaper that he could refinance his home and get quick cash. And he called up the mortgage broker who visited him, and the mortgage broker was unregulated. If there was ever a justification for regulating, it's if you look at where almost all of the problems in the subprime market occurred. It occurred in the unregulated sector, which was non-banking, as opposed to the regulated sector, which was banking. And the guy came in, and Frank is no dummy. He's not a genius, but he's no dummy. Asked him a question. He said, "How much more am I?" He says, "I need $50,000. Get you the $50,000. We'll just do a new mortgage at $30,000. 30 years." And so Frank says, "How much more am I going to pay?" And the guy didn't lie. He said, "In January you'll pay." He's paying about $1,000 a month, which is about a third of his income, a little less, so that's just fine. He said, "You'll go up to about $1,100 a month in January." Frank said, "I can afford that. Great, let's sign and do it." And he signs the document, and he didn't read it. And sure enough, on page 23, that the next January his mortgage was going up to $3,800 a month, which is more than his income. Should we hold Frank accountable for that so we can learn the lessons of the free market? Second, as I said, Frank was a prime borrower. Third, listen to this. This is not related to the four myths, but it's probably the most galling of all, and it shows the need for regulation. Of the $50,000, you know how much Frank got? $5,700. The mortgage broker, unregulated, got $22,000 of the $50,000 because he got commissions for how high the interest rate was, if it was a no-doc loan, if there was no prepayment allowed, if there was a prepayment penalty. The mortgage company, which is a company like Countrywide, one of the other ones that went bankrupt, got $11,000 of the $50,000. And then between the appraiser and this one and that one, they took the rest. Frank got $5,700, and of course he lost his home. And he was a prime borrower. Had he walked into a bank, they would have given him a prime loan. He would have gotten his extra money, etc. But he didn't know he could do any of that. So those are the myths all put together. Frank is far more typical than your poor, struggling inner-city family that finally gets manna from heaven in the subprime loan and lives happily ever after. And most of it, much of it, in terms of the foreclosures, were people who were being ripped off. Maybe legally ripped off. We have to change that, but being ripped off. Okay, so those are the myths. The administration plan just doesn't do much. As I said, they've twisted themselves in a pretzel to avoid government involvement. And as a result, it only covers about 10% of all the borrowers. This is the new plan that Secretary Paulson announced. And I met with his folks in Steele beforehand. And, I just get the feeling, this is me talking, that these guys are too smart to know that this is the right way to go, but they're marching within the confines that they were given. No government aid, no government involvement. and it covers only 10%. It doesn't help borrowers who have had their rates reset and have missed a payment already. It doesn't help homeowners like Mrs. Ada Diaz, who I met in Staten Island, another civil servant. She worked in a private hospital, another person who's losing her home even though she had enough money to pay because she was put in the loan. She's not going into the problem. She has the problem already. It doesn't help homeowners who were duped on their loans outside of the plan's arbitrary start and end dates. And because it's voluntary, each servicer sets their own eligibility criteria. So some borrowers will get help and other borrowers in exactly the same position won't. And I don't believe you can take this chance. Leave it up to each situation. Leave it up to each of the mortgage servicers to decide what to do, because it's fraught with difficulty. And then you have a final problem, which is if one of the 30 lenders, one of the 30 investors decides to sue, they can hold this thing up for a long time. So it just doesn't work. So what is the solution? And by the way, it's been widely discredited. The markets didn't react well to it. The experts didn't react well to it. And they're going to have to come out with another plan, just like the SIV plan before. All of these things that don't aim help directly at the bullseye, the person who's in foreclosure and needs help, are bound not to work. So what is the solution? Here are the 7 things that I think we have to do. And they do involve some degree of government action. First, the world's changed. I'm all for the secondary market. It makes things much more efficient. But you're missing that good old bank loan officer. If the bank doesn't make the loan, there's no one supervising the mortgagor, okay? And so if someone came to Frank, even after he started paying $3,800 and was ready to be foreclosed and said, you're a prime borrower, you have a good income, I can do a workout for you, be great. And if Frank's lender was a bank that still held a mortgage, like in 1985, that's what would have happened. It's very easy to train these people. And the federal government should put in, this is not a bailout, this is people on the ground to help those 55, 60% of those in foreclosure who are prime borrowers to do a workout. That's all it is. And it'll end up costing $5,000 or $6,000 rather than $200,000, which is what a foreclosure can cost at the end of the day if you add up all the other costs, external and internal. And we should simply pay for them, because no one else will. I tried to get some of the major banks and the major non-banks to put up money to do this, and yeah, one will give a couple of million here and one will give a couple of million there, but that's why we have a government, because it's not up to the private sector to do this. So that's the first thing we should do. For about $1 billion, every person who could refinance will have someone help them refinance. You could even train college graduates to do this. It's not that hard. And groups like the Center for Responsible Lending and others are ready to do it. Now, we did put $200 million in the new omnibus bill for some of this, so we've made progress, and they didn't veto the omnibus bill yet, so they're not going to. So there'll be a start, but we have to do more. That's the one thing you need. The second thing you need is money. Where's the money going to come from to refinance these mortgages? Someone on the ground knows how to do it, has the expertise. And there, to me, the place is Fannie and Freddie. They can provide liquidity. If you raise their portfolio caps 10%, you'll provide $150 billion. You require that money just for 1 year. Don't raise them permanently. You'll require that money to go to refinance these foreclosures. Fannie and Freddie don't really want to do this. They don't make enough money on these loans. Well, Fannie and Freddie, you're not just a private sector company. And you can't keep putting your hat on and taking your hat off when you want and say private, public, private, public. You want to be private sector only, and if your only mission is to increase your shareholders' price, then don't take the government guarantee. But I don't believe that's right. That's really what the administration and even Alan Greenspan wanted. They didn't want a Fannie and Freddie. I believe there should be a robust Fannie and Freddie, but I believe that Fannie and Freddie's responsibilities to the public sector are at times like this. And so Fannie and Freddie, we should raise their portfolio caps, require the money to go into this, and you know, some of us who have helped Fannie and Freddie in the past ought to jawbone them to do it. There's legislation that I've introduced along with Barney Frank to do this. We've also introduced legislation to raise the conforming loan limits for the GSEs. This one does have the support of the administration and Mr. Bernanke. And they would raise the limits of the so-called jumbo loans from the low 400,000s into the mid 600,000, so more mortgages would be covered. Jumbos are having big trouble, even though they're larger homes with richer people. And you give them a Fannie and Freddie guarantee, and it makes sense. Third, I will be introducing new legislation to provide additional liquidity into the markets. This would allow states and localities to use single-family tax-exempt bonds, the mortgage revenue bonds, MRBs, to refinance subprime loans at the risk of foreclosure. Currently, mortgage refinancing is not permitted under the MRB program. Fixing that's a good idea. The administration has proposed we provide a temporary 3-year increase in the volume cap that limits the state issuance of MRBs. Treasury officials tell us they had $5 billion a year in mind. That doesn't go far enough, obviously, and ignores one key fact. The reduced home ownership that's a result of the subprime crisis means we also need more money to go to multifamily rental housing. And the insistence that all of the volume cap go to single family is not ideal for cities that have been hardest hit by the subprime crisis, places like Buffalo and Cleveland and Detroit. So, I'll be introducing legislation shortly that expands on the administration proposal by doubling the amount of the increased bond cap they're proposing, making a portion of the increased cap permanent, and giving states and localities the flexibility to respond to a wider range of mounting housing needs. Fourth, my fourth proposal addresses the many subprime borrowers who won't qualify for refinancing. They have damaged credit, have lost income, have loans greater than the value of their homes. These people need judicial loan modifications through bankruptcy, and that could be a highly effective tool helping families recover from this situation. Today's bankruptcy code prevents courts from modifying, this has all been talked about, so I'll go through it briefly, from modifying the terms of a primary mortgage loan. The law singles out home mortgage loans as the one debt courts are not permitted to modify. Senator Durbin, my colleague and roommate, has proposed, and I've co-sponsored legislation to amend the bankruptcy code to make primary home loans eligible for the same remedies that are available on other less important debts. So if you did these 4 things, you wouldn't eliminate foreclosures, but you could greatly reduce them. And what would happen is the markets would say, someone's in charge, and this isn't going to get worse. And then the outward ripples, whether it be home prices, consumer spending, credit crunch, would feel some degree, I couldn't specify how much degree of relief, but it's a lot better than what's being done now. So those 4 proposals deal with the problem we face now. Next, how do you prevent it from happening in the future? First, and obviously, mortgage brokers should all have some degree of regulation and responsibility. The guy who went and saw Frank should not just be a freelancer, a guy in the Wild West who can do whatever he wants. He's happy, by the way. He has his $22,000. Who knows where he is? And so we should regulate these people, plain and simple. And the mortgage brokers will say, well, there are a lot of good, responsible mortgage brokers. Well, then they won't mind the regulation. We don't regulate for the good, responsible. We regulate for the rogues who hurt everybody. I'm sure if you're a good mortgage broker who never did these things, your reputation's suffering right now and you don't like it. Regulation will prevent the bad apples from doing the kinds of things they did. They were encouraged. I don't have much faith in the countrywides. they encourage these bad people by giving them bonuses and giving them everything else. But that's for a different day. So we have to have regulation. I put in legislation 4 months ago that did this, basically the same degree of regulation that we have on bank lenders. We do give the first mortgager, the first lender, some degree of responsibility. I think it's hard to say the people who buy a little piece of one bond should be responsible that the mortgage broker did the right job, but the initial lender should be. And so we give them some degree of responsibility and liability. And Senator Dodd just introduced legislation that is pretty close to mine. I've co-sponsored it, and hopefully we'll pass that early next year. It's a little stronger than the House legislation. So that's first. That's to deal with the crisis in the future, to prevent these mortgage brokers from coming in. Next, we have to look at the role of credit agencies. How did all these people get AAA ratings? I've called in the head of Standard & Poor's and Moody's, and they're New York companies. I like to defend New York companies, but they didn't have any good answers. And it may be the whole system. One of the reasons that there's a credit crunch is people now don't trust the credit rating agencies on anything, except maybe U.S. governments where they're not needed. And how do you deal with that? Well, you may have to change the whole structure of how the credit rated agencies work, or at least encourage alternative structures. You know how it works now. The issuer pays the credit rating agency after they give the rating. So first there's the basic conflict of interest that your rater is being paid by the ratee. And second, you don't even pay till after they give you the rating. Back in the 70s, investors paid the credit rating agencies. And so there was a lean to being tougher, as opposed to a lean to being more lenient. And each one has a lean, obviously. One of the problems there is it was all private. If I'm a potential investor and I want to know what this investment is worth and I pay the credit rating agency, I don't want to let my competitors know what they found out. But this is something that we have to explore. And so those are my basic proposals. Oh, I left out one. I knew there was one I left out. Simple disclosure. This one everyone can agree on, free market or not. Put in legislation that there should be, I was the author of something called the Schumer box, which created for credit cards. They had to state what the interest rate was and the penalty in big letters, right on each application, right on each advertisement. I worked with the Fed on this. It brought down credit card interest rates. Before that, again, we had the free market guys. Well, it's on page 22 of the agreement that they signed. But no one knew what the rate was. Now they did. Rates came down. We should have a one-page front cover of every mortgage document. And it should say on it what you're going to pay now and what you're going to pay a year from now and what you're going to pay 2 years from now and 3 years from now. And I understand that, in a variable rate world, it'll need some degree of clarity. But you can do that based on today's interest rates and put a caveat. Something that Frank would understand. And you do these 7 things. The first 4 go to ameliorating the present crisis. The next 3 go to preventing a future crisis. All of them do involve some degree, God forbid, of government involvement or regulation, but it's the only way to solve it. And so I would hope that before the crisis gets much worse, this administration will realize that the reality of the situation will force them to take off these ideological handcuffs, roll up their sleeves, and work with the Congress and people like myself to solve the problem. Thank you. Mr. Polanki. Okay, ready for your questions. Yes, sir.
Hello, Senator Schumer. I have a question about your. Oh, I'm sorry. My name is Ken Temkin. I'm a policy analyst in town. Your four policy interventions, which seem very reasonable and thoughtful, all have a theme, which is to get the borrower to refi out of a mortgage now that is not particularly good for the borrower.
I can't hear you.
I'm sorry. Your four proposals are variations on a theme: to get a refi in, get a better loan to replace the one that is likely to lead to foreclosure, already has led to foreclosure.
Right.
My question is this: since so many of these subprime loans have been securitized, are there constraints within the bond documents that prevent the loans to be refied out? Some of these bonds don't allow more than a very small percentage of the loans to be replaced or written down, for example.
Right.
And how do you address that constraint to the ability to refi loans?
Okay, couple of things here. Most of the servicing documents do say that if they're on the brink of foreclosure, there can be refinancing. They don't say there can be a credit freeze, so that makes the administration's proposal less susceptible. But they do say this. It's sort of standard language, and it is up to the servicer to make that determination. Second, I think that most of the borrowers, almost all of them, you see, again, you do a credit freeze, you have to worry about which pieces of the loan get paid and which don't and who comes first. You do a refinancing, everyone's going to get repaid. It just stretches it out. Yes, sir, way in the back. Yes.
Yeah, hi, my name is Creighton Jones. Though it seems you're pretty well-intentioned with your plan, it doesn't really address the fundamental crisis, which is that, because it seems a lot like what the Fed is now doing, pumping in more money to try to bail out the value either of the homes or the securities, et cetera. Now, I work with the economist, Lyndon LaRouche, and he's called for a total freeze on foreclosures. End foreclosures, keep people in their homes, go for a revaluing of the price of the homes because they are hyperinflated, and then free the banks, the local and regional banks, from the predators, from the securitized debt obligations, et cetera.
Let me just say to you, sir, I think you'd have one problem with just a freeze on all foreclosures. It's called the Constitution. There are various contracts between people that do allow them.
Roosevelt used it. Roosevelt did it, and he was a follower of the Constitution.
I think it would take, it took about 4 years to sort it out.
Right. It's going to take that, but this is the general welfare principle.
My view is this is
the people first.
This is a quicker way to help get to the same problems that you're talking about. Let me call on the next person. Yes, ma'am.
Hello, my name is Tori Harrison with American Systems
You'd have
Publications.
to speak up, ma'am.
Okay. I was curious that Larry Summers and yourself are proposing solutions that are somewhat temporary and in kind of heat of the moment. And I was wondering what you think about creating a capital budget for long-term infrastructure projects to reinvest into the economy. And the reason why I mention that is right now the real estate market is about 50% or more of the United States economy, whether it be your plumbers, your electricians, people in Wall Street, which is not productive, building houses and then making money and revaluing those houses. So what are your thoughts on a long-term capital budget to re-stimulate the economy for 25, 50 years?
Well, look, I think there have been a number of interesting proposals. Felix Rohatyn made a proposal along those lines. I think Bernard Schwartz and some of the others did too. I think it's something to look at. I think it doesn't deal, I think we'd first have to deal with this issue because it's more immediate and creating more problems. But I will say this, and I'm not sure the best way to get there. We have huge infrastructure needs over the next 25 or 30 years because most of our fundamental infrastructure, roads, sewer, water, was done 50 to 100 years ago and has to be redone. And when I go around New York State, the number one in suburban, smaller cities, and rural areas, number 1, 2, or 3 on the list of the local governments is how are you going to help us with our need, not for roads, which is more federally and state-oriented, but for water and sewer. So this is a serious problem, I agree with you. School buildings, everywhere. How we deal with it, I don't know. I mean, I greatly worry overall that since 1980, that government, the federal government, has had a much more restricted role, and the next 25 years we're going to pay a price. And we better figure out how to adapt to that in terms of infrastructure and in terms of education and in terms of many, many other areas. You know, we have a great system. I don't want people to think I don't think it is. I think our system is the best in the world. I think it has the right blend of entrepreneurialness and regulation. I think we're the only country in the world where anybody, I'm sitting next to the head of Deutsche Bank, very nice fella, and he said, you're the only country in the world where somebody comes here and can really aspire to the top. And we energize people, no matter what their background and what their economic level, the way China doesn't, India doesn't, Europe doesn't. It's great. So we have all of this going for us. And the anxiety I have as somebody who loves this country, I think we have let things lag rather significantly over the last 25 years, but particularly over the last 6 or 7, and we better figure out ways to deal with it, and infrastructure is one of them. Yes, sir. Although the number one thing I worry about is our education system. It is declining rapidly. It doesn't get the attention that the healthcare system does. Obviously, if you have someone who's sick, that's your first concern. But our education system has declined so that if we don't change it in a very significant way, we're not going to be the leading economic power of the world 25 years from now, and I don't want that to happen. Sorry.
Senator, thanks. Gary Mitchell from the Mitchell Report, although probably not the one that you might be thinking about this week. I'm interested in the politics of both the quick fix and the longer term fix. And in your comments, as I recall, you mentioned both Senator Durbin and Senator Dodd, and I'm interested to know to what extent there's an appetite for this on the other side of the aisle, and whether you've got any prospects for partnership and or leadership there.
No, this is, this would be a more general comment, but I do believe that too many on the other side of the aisle are simply following the administration position, and we used to see more independence from at least a certain core of those folks, and it's hurting us. It's hurting us in a lot of different ways. As the crisis gets worse, that may change. And look, even the administration's position has changed some. It's just they are so bound by their ideology that they're always, a day too late and a dime too short. So I think we will see some changes as this gets worse, but we could be ahead of the curve. Yes, I'll take the last question from you, ma'am.
Hi. Felix Rohatyn's proposal, which you cited for infrastructure.
I'm sorry. Yeah, go ahead.
Felix Rohatyn's proposal for infrastructure, which you cited, uses private financing. The federal government is actually indebted to private companies. And I know the ATM reference you made, that this homeowners bank of Atlanta is bailing out Countrywide.
Yes.
Well, these proposals right now are simply to bail out the financial interests. If we don't actually put a freeze on foreclosures and mortgages as a whole, as a piece of an overall policy package, as Roosevelt did, that also increases the physical production of this economy, then we are dead as a nation.
Okay, well.
And as being from New York, you should really think about the tradition of Roosevelt in this way.
Well, I think of his tradition every so often. But I guess I would say this. I think that generally, there are certain activities that are best left completely to the private sector with maybe a light degree of regulation. There are some activities that belong in the government, and then there are many in between. And I think I'm actually less worried about the structure of how to refinance infrastructure and more worried about the resources that are going to be needed to do it. Thank you, everybody. Thanks, Doug.
Thank you to Senator Schumer and Larry Summers. That finishes our program for today. Thank you all very much for coming.